Good afternoon, everyone, and thank you for joining us for this afternoon's presentation, the CECL Journey. Today we'll be covering step number 1 on the CECL Journey, which is the must-dos. We have a very informative presentation for you today, and we're looking forward to giving it to you. Just a few housekeeping items. If at any point during the presentation you should happen to have a question, please feel free to type it into the box on the right-hand side of your screen. And if we have time at the end of our presentation, we'll go through those and answer any questions that you might have. And now it's my pleasure to introduce to you Peter Cherpak, who is a thought leader in CECL and stress testing. He has given presentations for the Risk Management Association, American Bankers Association, and been published in publications including American Banker and others. Peter?
Well, thanks, Matt, and good afternoon, everyone. Thanks for joining us for a little bit of time to talk about this important topic for banks of all sizes, which is the new CECL rule for reserve calculation and what it means to each bank. And then we're going to talk about how Ardmore and Argus have partnered with CSI to deliver solutions, and some of which are pretty creative to this problem that will help all institutions. And so appreciate your time. We'll start out with an overview of CECL. We'll do a quick introduction of Ardmore and Argus so you know who we are, and then we'll talk about at a high level what CECL is, and then we'll talk about the solutions that we have available that a number of CSI banks, both Meridian and Newpoint, have taken advantage of. And then at the end, again, if we don't have time, we'll take any questions you have. If you type them in the box on the right side, there's a comment area. You can do that, or you can drop me an email. I'll give you my email address. So first I want to introduce Ardmore Banking Advisors, which is the company that I represent. I'm a partner there. I've been there 16 years. The company itself has been here for 25 years, or actually 26 now. And we are a community bank credit risk management consulting firm. We help community-sized institutions who are typically challenged with resources and time. We help them become more efficient in their credit risk management, and we can do traditional consulting and loan review services, as well as helping banks with regulatory requirements, whether it's individual banks under agreements or dealing with issues that are more global, like stress testing and CECL. We have worked with CSI for over 7 years, attending their conference for the last 5, and as sponsors, and also CSI has used Ardmore to help them with their credit risk management tool sets and helping some of their institutions use them more efficiently. We're very close with CSI, having worked with them for so many years, and we feel our values are very similar to theirs as far as making sure clients are satisfied, and hopefully we'll have the opportunity to show you the same. Argus Information Systems is a software provider that Ardmore has worked with for really since 2016 to develop out the CECL solution specifically for community banks. Argus is a global supplier of bank compliance software, headquartered in White Plains, New York, and they work with some of the largest banks in the country, and we helped them develop out a solution specifically for community banks, which we're going to talk about. So basically, we see this as sort of a three-legged stool where CSI is your host and core provider handling all of your data. Argus is the software provider who's built out the platform and the databases to manage CECL and do the calculations. And Ardmore, we are the credit experts, and we're the CECL experts. We are the people who you would ask questions. We're the people who help guide you through some of the best practices, and we also implement the solutions of Argus. So we really think it's a best-of-breed solution where we have all three of us working together to deliver to you something that's valuable and useful. So that's our introduction to who we are. What I like to do is always like to start out with a poll, if we can, and we'd appreciate you participating if you would. We just want to first get an idea of the size of institutions we're talking to today. Always helpful to just get an idea of approximately what the spread is, because it is different. And one of the things I think is important, because you're probably hearing a lot about CECL, but it's different for different size institutions. And the tools you have to use, the problems you're facing, the resources you have available are different for different size banks. So I just get an idea, and we're going to hold for another minute. And I appreciate everybody voting just so we can have that. And we'll show you what we have. And so basically, you can see that 80% of the people on the phone today are in that $100 to $300 million range, which makes a lot of sense. That, although we do have clients who are basically all over the map, because CSI does have banks in the billions and banks that are less than 100 million. We have sold the software to and some of our solutions to both ends of that spectrum. Okay. Let's talk about what CECL is real quick, and then we can talk about the solutions. This is not going to be a detailed overview of CECL. Instead, it's going to be a high-level discussion. So, it's a principle-based rule, and what that really means is that with CECL, the bank is given a set of guidelines to follow, and those guidelines are very subjective. The bank is able to do a lot within the confines of what the CECL rule is about. There are some basic things that they have to do, and then there are things that they can do, and it's really up to the institution to decide which way they want to go. The intent of CECL is to allow banks to anticipate economic downturns and deterioration in their loan portfolios, both consumer and commercial and mortgage, by actually putting aside more reserves based on their belief of economic change and change within the portfolio. The idea is to not be over reserved when you don't need to be, and not to be under reserved like we were last time we had the economic downturn, because of the fact we're always looking at lagging indicators for our reserve amounts. One of the key concepts is LOL, which in this case stands for life of loan, because the concept of CECL, the main issue is that we want to be able to calculate the entire loss for the loan at the time that you book it. So it's a little bit different than standard GAAP as we know it today, because typically you're getting paid for your risk as you take it. In this case, we're taking all our risk at once. At the time the loan is booked, you have to be able to write it down to what you think the actual collectability of the funds are. And of course, that happens immediately. And during the transition, most banks around the phone here are probably going live 2021. You have to actually go from the old methodology to the new methodology directly in one shot, and take the hit for the life of loan loss at that time. So obviously this involves projecting what you think is going to happen to the economy and to your portfolio. So you have to do what's considered a reasonable supportable projection. And reasonable supportable is very subjective. What you think is reasonable supportable will hopefully be what the regulators and the auditors think, but there's no guarantee. So one of the things we have to learn as the best practices for smaller banks evolve is what is reasonably supportable as far as how far out you're going to predict your losses on a particular pool in your ALLL. That could be short for some banks and longer for others, as long as you can justify and document your justification and your criteria as to why you're projecting, say, 6 quarters and another bank is perhaps doing 8 or 4. The way the calculation works is after your projection period, you're supposed to revert to your historic loss rates. So you start out essentially with your loss rate, and then you adjust it for life of loan and future projections, and then when your future projection period ends, you revert to your historic loss rate. That's basically the way it works. And all of these things have to be justified, including if you think you're going to have losses, why you think you're going to have losses, or downgrades, or some sort of deterioration in the portfolio. All that has to be documented and explained in your narratives, and hopefully empirical data that you have, and we're going to talk a lot about data in the next few minutes, CSI Meridian data, but hopefully the data can support your projections. Now, one of the things and one of the reasons we wanted to talk today with you is that I know, having worked with a number and talked to literally dozens and dozens of CSI banks, both Meridian and NewPoint, that a number of banks think that maybe the problem of CECL can be solved just by hiring a vendor. And they focus primarily on the whole idea of the calculation, but that's simply not true. Unfortunately, even if you hire a vendor can only do so much for you. Even Ardmore and Argus and CSI together can only do so much. It's really up to the institutions to do a lot of the heavy lifting. I'll give you an example of how the journey can go. We always start our solutions with a data assessment process. So the first thing we do, if you are working with our solutions, this data is going to flow from CSI directly into our databases. So unlike other solutions you may have heard of, you will not have to create data, you will not have to get your hands in the data, it's going to simply flow over for our solutions. But first thing has to be done is to look at that data and say, is this going to be adequate for CECL? Do you have the data that you need? Are you collecting the right data? Because honestly, a number of banks out there don't collect a lot of credit risk characteristic data, which is what CECL is looking for. And that kind of data includes things like a detail about the type of loan and collateral beyond just collateral code or collateral type. And also looking at detail around the borrower's financials, some of their ratios, credit scores, perhaps DTI and other things like that. These are the things that CECL wants to use to track riskiness of credits and justify projections. If you're not collecting it, obviously it's not going to be there to help you. And we need historical data significantly. This is definitely a challenge for Meridian banks who mostly don't have access to history through Meridian. So that would mean, to some degree, your historical data is going to be whatever data you've got that you've been using to create your ALLL to date, as well as any other data you might have saved in trial balances and spreadsheets and the like. But historical patterns of performance need to be tracked and fed into whatever calculation you use. As I mentioned, macroeconomic indicators can be used to help justify your projections of the future. And those could be any number of things. Here are just some of the things to think about when it comes to CECL. And there's also the whole issue of governance and policies and controls. I mean, obviously, this is now part of what we are going to use as justification, but it's also data that's going to investors and the street. So you have to make sure you have governance and controls over the information that goes out. Also, because it's such a subjective standard, there are many ways that you can actually do the CECL calculations, and you have to be able to analyze which one works best for your bank, and that's not necessarily something that every bank's going to have time to do. So it's important that you have the resources available to test and make sure that whatever we choose works best for your portfolio. And we talked about coming up with this reasonable supportable projection period. There are numbers of ways of integrating these projections into your loss calculations. The Q factors, the qualitative factors, are one way to do that. And basically, there are other ways to do it as well, and I'll show you an example of these. But you've got to figure out what your period is you want to project for, and then how to take those projections and integrate them into your loss rates to create CECL. Finally, the goal is to create, obviously, an ongoing, validated and controlled process that's repeatable, that's not highly volatile, that's auditable, because all this is going to be audited. So vendors like Ardmore and Argus, or other vendors that you may have talked to, can help you with some of these things. We can give you ideas of what best practices are. We can give you suggestions on what you should be doing, but the vendor's not going to be able to do this for you. It's something that the bank's going to have to do. Data is a concern because of all this data that's needed. And a couple of reasons that you would need data, and by data I mean your information about your portfolios, is that you have to be able to calculate a life of loan history for the entire pool. So if you're, for example, using call codes or collateral codes on Meridian to create your pools, you, in theory, would have to go and look at that pool for entire life of loans in that pool and come up with a life of loan loss and a life of loan. And that can be really tricky if you have just a few loans in a particular pool or minimal history to work with. There are different impediments that you have to worry about. And one of the key tenets of CECL is that if the current pool structure isn't risk-based enough, you might have to change your pooling structure. So for example, I'll give you an example of this later, but you may have to break your pools out. One of the reasons we say that is in the actual ASU rule itself, it shows a disclosure with pools broken out by, for example, commercial risk rating. And you have to calculate losses of those pools over time. So the more data you have, the more flexibility you have. Also, using data to correlate what's happened in the economy, if you're going to project that interest rates are going to go up 300 basis points and you want to justify why you think you need to change your reserve to accommodate that change that you see coming, you'd like to have some data to support that. For example, changes in your portfolio performance over time. And if you don't have that data, you may be having to look elsewhere, looking at peers, looking at other information that's available to justify. Regulators and auditors like to see you use your own data if you have it. And if you don't have it, you should be collecting it so you will have it. I mentioned the disclosures. You have to, within the data, you've got to prove the data is accurate. Right now, I know a lot of data is downloaded from report writers into Excel and manipulated extensively before being used for your ALLL. That kind of handoff and manual management is not going to be looked at favorably. Certainly you can do it if you have the right controls around it, but they're really looking for accurate and controlled data management. And documentation. I've worked with a couple of banks and asked them to show me how they code their loans, what criteria they use to risk rate them, what criteria they might use to put them into different buckets that end up impacting what pool they're in, and there is no documentation at all. It's all being done in their heads, which is fine when you don't have to be audited, but when you have to be audited, it's not so good. So data is important. Some of the issues that you have to worry about is actually defining the life of loan. Contractual life of loan is not necessarily the life of actual loan. So if you've got 20-year commercial mortgages and they also pay off on an average in 10 years, you don't want to calculate 20 years of losses, you want to calculate 10. So really looking at how long your loans perform, how long they are on the books, I should say, and you have to consider prepayments, charge-offs, TDRs, all that kind of thing. It's tricky. Again, what kind of pools are you going to use? Really doing that whole adjustment for reasonable, supportable economic condition projections. And all these models have to be validated internally. So even if you create an Excel-based version of this, you're going to have to validate that on an annual basis and show the auditors that what you're doing is what you expected and the results are what you want. And disclosures are pretty extensive. So here's an example, just to give you some illustration. This might be your current collective loss pools, which could be by report code or could be, in your case, collateral codes. You might have something as simple as this. Under CECL, you might need to have something more complex because these pools are based on assets, not necessarily by risk. So you can see in this illustration, we've taken some of the commercial credits and broken them out by past, substandard, and doubtful. Others, we've used LTV bands to fall in line with regulatory expectations for HVCRE. Others, we've used credit scores or delinquency. I'm not telling you have to do it this way. I'm telling you these are some of the examples that we've seen. Smaller institutions like yourselves may be given more of a pass in this area by the regulators. We're trying to find that out. Ardmore is very involved with the American Bankers Association, the Risk Management Association, and the regulators themselves, and we continue to try to bring the agenda of the smaller bank to them. And one of the things we keep saying to them is, can we continue to use our pools? We need to know, because we can't, that means we're going to have to break them apart. And for small institutions, that might end up with pools so small that they're really not statistically valuable. So here's an example for those of you who, and I'm not going to spend a lot of time on the math, but for those of you who have said, I don't understand the difference in the calculation between a CECL and a non-CECL, let me just give you a real high level. So in the old incurred loss model, let's say that, here's really what we say the life of loan is for this pool. And what you would be doing is looking at individual losses, annual losses, and creating an annualized loss rate. So under the old method, the method you're using now, you would create an average annualized loss rate, apply that to the balance of the pool when it started, and then add some Q factors for local conditions, and there's sort of 8 categories of Q factors, add them together and multiply those times the recorded investment and get for a pool and loss. Under CECL, what you don't do is create loss rates and annualize them and divide them out. You actually add them all up. So life of loan loss for the pool would be all of the losses year by year added together, then creating a loss rate by dividing that out. And you'll see your loss rate is much higher. And it just makes sense that you adding them all up will be more than just coming up with an average. And then you also have more Q factors because you have the current conditions, you have forecasts, various factors that you're going to add, and then you might come up with a higher number like that. Now, this is an example. It's not necessarily the only way. It's quite possible that you'll have things go the other way in your institution, and you might actually find yourself reducing your reserves, although when we've heard regulators say that if you plan on reducing your reserves under CECL, you're going to have a lot of explaining to do because they kind of look at the expected credit loss being something that is bigger than the incurred loss because of all the factor adding together the losses. But this is just one way to look at a pool calculation. There's about 7 different ways that are approved to do it. And the idea is you have the subjectivity that you can choose any of those ways. The good news for institutions that use our solutions is that CSI's data is mapped directly to our data marts. So every bank gets a data mart, their own data receptacle, which is what the regulators say you should have. And that is where you're going to accumulate your data for CECL. So once it comes out of Meridian, it's going to go directly into the data mart, and every month a new load. We've already added all the codes that you need to do CECL. In fact, we've got those required to do the calculations, and also those that we think are good to have, a good to have list based on having credit risk criteria available. Here's an example of one of the disclosures where you can see that they've taken an asset class and then broken it out by risk rating and done it over 5 years. Smaller institutions don't have to do the 5-year break. You could do 3 years. But if you think about it, that means you've got to start in 2018 to get to have 3 years by 2021. So there's some other issues about reverting historical loss rates. I'm not going to go through this in great detail, but the idea would be if you project what you think the losses are going to be. Let's say you think there's a bubble bursting and you're going to bring your reserves up, and you're only going to do this for a certain period of time. So let's say you're going to do that for the first half of the life of the loan. That's as far as you can project. If you revert to the remaining historical loss rates, you're going to have a bit of a cliff there if it's historically not as high as what you're projecting. So the real question is, can you smooth it? Do you want to drop off the cliff, as it were? We're trying to keep things from being too volatile. So it's important that you adopt methods that do that. You can do this any way you want, as long as you can justify it in a way that both the regulators and auditors approve. Quick point that at the end of February this year, I don't know if any of you may have attended this, the regulators did do a webinar on implementing these solutions for less complex community banks. They did not define what those were. Now, you may consider yourself a less complex community bank, but you'll have to justify why you think you are, because they said they will not define any criteria. But essentially what we're saying here is smaller banks have different issues, and it was great to see the regulators addressing that. And you can see they have people from the Fed, the FDIC, the state, FASB, and the SEC. And here are the takeaways that we got from that. One was that a bank can do the calculation in a lot of different ways, because they showed about 7 ways to do it and they said you can use a spreadsheet to do the calculation. But that creating a reasonable and supportable life of loan estimate is going to be really difficult and challenging for a smaller institution. You really don't have typically the data stored to prove how your loans perform for the entire life of the asset. And you also probably have segments with no losses at all. And in the last, foreseeable past, and the question is, what do you do then? Because we know 0 is not the answer that they want. So banks are going to be extremely challenged in that area. And the Fed stated that they did not want banks to maintain all this data on a spreadsheet. So what they didn't want to see was you downloading from Meridian the trial balance in the spreadsheets, manipulating that and storing those as your historical data for CECL. They want you to have a more controlled process. One of the reasons why we offer a data mart in our solutions. The FDIC said pretty plainly, your internal data will probably be insufficient, and you're going to need third-party data to do CECL. This is a challenge for community banks to come up with affordable sources of third-party data. FDIC, UBPR peer data is probably a good place to start, but even that you'll have to modify to meet your particular institution's practices and performance. In this webinar, there was no explanation of how to do the forecast. They focused purely on the calculation of the loss rates. Other key points is that they said you better be starting now, and this was back in February, because if you haven't been collecting the right data, you're really going to be behind the 8 ball with CECL. You're not going to be able to be flexible and able to choose the options that you want if you don't have the data to work with. That your loss and projection estimates may be a best effort at the start, but you're expected to get better over time. So you want to start with a framework that is scalable, and even if the first go round you can't do the calculation in a great amount of detail, but you need to be able to grow into it. There's an expectation that you will show that. You should really start now with some cross-department CECL project teams. And they did mention on vendors. You can use a vendor, and I have new in there in that your core is obviously a vendor you already have, but you can use a new vendor for calculation and data management, but it's up to the bank to decide. They said you can do it. If you want to leverage vendors to help you with this, that's fine, but it's the bank's risk, regardless of who does it. And no bank, no matter how small, is exempt from CECL. And I know, I heard you groan, but it's not going to happen. It's not going to get wiped away. We have had recently some relief on the capital issue. The FFIEC floated out an idea that said maybe when you move from the current incurred loss model to the CECL projected model, you can smooth that impact over a couple of years. And that's out there, and we support that. We think that's a great idea. But it's still going to be a significant impact, and you're still going to have to do CECL. After all, it's an accounting standard. It's not a regulation. So it's not going to be part of a regulatory relief bill or something that the current administration is going to touch, because it's really an accounting standard. So sort of wrap up this portion, I want to just talk about this whole CECL journey and where you should be. After all, that's what we called this webinar. In 2018, and this set of to-dos kind of comes from the peers that we work with, American Bankers Association, RMA, as well as the regulators themselves. At this point, you should have a CECL awareness group, and in a small institution, that could be, the CEO, the CFO, and the chief credit officer. But you need to have people aware that it impacts everybody. You should be looking at your data and assessing if you have the data you need for CECL, and if you don't, how you're going to plug those gaps. This is, again, a service you can do yourself, or you can use people like us to do for you. If you sign up for any of our solutions, we'll do that automatically as the first step. We've already done this for 6 CSI banks. We have a 7th schedule. Looking at what your policies and practices are, and also start thinking about your project plan, how you're going to get from here to there, because the regulators will be asking you in their safety and soundness what you're doing about CECL. And if you say, I'm not doing anything now, or I'm just waiting to see what happens, it's not going to be a good answer. You're obviously, as we get past 2018, you're going to start wanting to start building your models out, whether it's a vendor introduced model or it's something you're trying to create yourself. Because really, you're going to want to be running parallel by the end of next year with your current and this future method, so you can understand the capital impact and start planning for it, so you can start to fine-tune your approach and have a working model in place. Where you are on this journey is really depends on the institution. And so I'm going to actually do another poll, but hopefully we'll recover from this one better than the last one, and just find out, where you are on your journey. And so we're going to ask you to just give us a hint. So you see a poll on the screen. Where are you on the CECL journey? You haven't started yet. You're planning, but that's all you're doing is thinking is planning. And planning's fine. I mean, planning could be going to webinars like this. Planning could be meeting. Some banks are already working on their data, already looking at what they're missing, what they need to add. And then, others are actually at the point of running some models and testing them out. Although in our experience, those are usually the larger institutions. So we're going to, just one more minute, and then we're going to show you the results of the poll. Okay, Matt, see if we can do that. And thank you for participating. We appreciate it. So you can see that by far, most banks are just in the planning stages now. So we do have some that are working on the data and some that haven't started at all. So for those who haven't started at all, it's good that you're on the webinar today. And the next step would be working on the data. So let's see if we can go back to the webinar. And it looks like you should be able to see the slides. And thank you. All right, so where do we go from here? Let's see if I can do that. All right. How can we help you? Now, we've got a few offers of things that we can do for you, and a number of CSI banks have already taken advantage of these. And there are 2 main solutions that we offer to CSI banks. The first is a software solution that is an entire software suite that can support not just CECL, but your current ALLL, as well as other credit portfolio management tasks. A software suite is really for a bank who says, I'm going to collect my data, I want to put it in the data mart, and then I'm going to use it right away. I don't want to wait until I just use it for CECL. I want to use it now. So this solution, your bank's data is transmitted automatically on a monthly basis to the Argus Data Mart, which is the center of the program. It's really a storage area that's organized into tables. That is where you can keep your archived data. And then we follow a process. First thing we do is we pull a data feed and we do a data assessment for you. We meet with you. Typically, we do it with GoToMeeting like this. We present to you what we found and our suggestions on how you could use CSI better, what data you could add. We'll talk data consistency and quality, and talk about how you can enhance for CECL. While you're doing that, if you have the software suite, you'll be able to actually automate your current ALLL if you like. That a number of banks feel that that's good for them. It helps them automate and prepare for a parallel run. We also have a credit reporting module, so we can create concentration reports, slice and dice the portfolio, look at trends. And this can be very important with CECL, because as you saw, there's a lot of justification needed. And one way to justify some of your portfolio management options is to have data available that you can show. So you can use this product to do that and automate your board reporting as well. And then there's a stress testing module, which is a community bank stress testing model for shocking the portfolio. If you're, for example, an ag bank and you think that it's possible that subsidies are going to change, or you're a CRE bank and it looks like multifamily bubble's going to hit, you can test these things and show the regulators that you're doing it. This is a full CECL compliance when we add the CECL calculations to the ALLL module, and you can actually then run parallel. And so this is a solution for banks who say, I want this, I want to get it in place, and want to start using it. That may not fit for all banks, but for those who do, and we have a number of CSI banks that are using this already. This is kind of how it works. As you can see, you have there's a direct feed, a secure feed to your Argus data mart. So you don't have to touch the data, you don't have to prepare it, you don't have to transmit it, it already goes there. You can add other data. So for example, let's say you do, and I'm going to make this up, but let's say you rescore your largest consumer loans on an annual basis. Well, if you want to keep that data somewhere and you don't want to put it in Meridian, you can put it in here by just uploading a spreadsheet. You can also add other data if you have collateral information or other things off core. And once you have it in a data mart, you can use it for your current ALLL as well as CECL. You can do it for reporting and stress testing. And it has all the features and functions automated that you want, including multiple scenarios. So if you want to test things, if you want to try different ways of doing the calculations, it's all built within the product. And it comes with a ton of reports, which is always good because we talked about all this justification you're going to have. All the examples of why you're making changes in your ALLL. So having the ratios and the operational reports, as well as closure reports and analytics, and I'll show you a couple of these when I get live in a second. Stress testing reports and portfolio reporting. Now the second solution, that's the first solution that we offer, and as a partner of CSI, we have the opportunity to share some of the revenue with them, as well as be tied directly into their core. The second alternative is for banks who don't feel they want to commit to an automated credit portfolio management solution, or even a CECL solution in 2018, because they don't feel they're going to use it, but they understand that they need to start collecting data. They understand they need to start their process. So the bootcamp subscribers, it's an annual subscription, will get a data mart. So Argus will set up a data mart for you, which will enable you to start archiving your Meridian data and storing it away for CECL. And that is something extremely valuable and really a first step. The hourglass, the sands of time are going through it. The longer you wait to start collecting data for CECL, the less data you're going to have in 2021 when you need to use it to justify your CECL projections. So I would highly recommend to all the Meridian banks that if you're not doing it now, you should be pulling a pretty thorough trial balance and putting it in Excel and saving it, because historically Meridian data does roll off. If you join the bootcamp or buy the software, we'll start archiving that data right away. Within the bootcamp, you still get the credit data assessment. We will still do a hands-on individual bank one-on-one on looking at your data, telling you what we think you need to do, improving your process, suggesting changes and additions. We also will have ongoing group training classes. So those training classes will start probably end of this month. We're hoping to get 10 bootcamp members, and we're up to 7. So we're hoping we'll get a few more signing up, because I have a couple proposals that people have said they will. They're waiting for approval. So we'll start our ongoing group training classes, and the first thing we'll do is have even though we do a credit data assessment, we'll also have a group class on data and what you should be doing, what fields you should be using, what some of the best practices are. And then we'll go on to other topics appropriate for where you should be in the process. And then you get the CECL portal. And the portal is exciting. We're having a webinar actually about the portal in detail on Thursday, where you'll actually be able to log in, post questions, put discussion information out there. It's a discussion forum that is shared only with the CSI bootcamp banks, where you can ask questions, say, this is what's happening. This is what I'm hearing from my regulator. What are you hearing? You can also post questions to experts. like Ardmore or Argus or CSI. We'll answer those questions. Everyone can see those as part of our, collective intellectual property on this challenge. And you'll have access to all of the webinars like this and other webinars we've done historically, white papers that we've written. All the resources that are available will be in your portal. And so this is really for a bank that says, I don't want to commit to a software package. I do know I have to get started collecting my data. I do want a data assessment, and I'd like to have some training along the way. So that's what the bootcamp solution is. You get the data mart, you get the consulting, you have the portal, and the webinars, the group webinars. You are not required to ever upgrade to the software package from the bootcamp, but you can if you want. So we already have some banks that have told us that they're going to get approval for the entire software solution. So when they need it in 2021, they can get it. But for now, they're just going to join the bootcamp and participate in that until they're ready to go with the software solution. So we're trying to accommodate banks who are in that mode as well. There's an example of a bootcamp login. And looking at discussion threads, looking at webinars available, really a detailed archive of CECL information that you can use. And if the bank is under no obligation to renew, so if you do it for a year and you don't think you're getting value, you can get your data back. You can dump it back into Excel. If, for example, you determine that you think you can do CECL on Excel, you can still have the data mart and you can use that as your secure, auditable archive and then build your own model on top of that. So I think it's a pretty flexible solution and pretty unique within the industry. The bootcamp costs $6,500 a year. The software is $15,000. And the first year we are discounting if you buy in 2018. If you buy the software, discount the first year to 10. So the idea is you can either go all the way with the software, you can go just with the boot camp, or you can start the boot camp and upgrade to the software if you want. So you can talk to your RM out there, your account manager, or you can talk to me if you're interested in more information. Most likely your RM is just going to refer you to me, but that's fine. Sometimes we have the RM sit in on our presentations and sometimes not. So if you think this is one of these solutions, it makes sense for your institution, please reach out to us and we will be able to do a one-on-one discussion with you and talk about in detail what these solutions can do. So I've got a couple minutes left. I did want to show you very briefly what some of these solutions look like. So I'm going to just want to show you some of the reports, for example. We're not going to do a full CECL demo. But you can see here, this is the Argus solution. We can go into the CECL portion of this. Let me sign in. Very user-friendly, dashboard-oriented. So for example, if we go into the ALLL process, it's a workflow where you've got a dashboard. You have your collective pools, your 450/20s. You've got your individual impaired credits, TDRs. As you review them and get them straight, you can take them out of Meridian, populate this, and then adjust here for changes in pools. You can look at the detail. And you have a lot of information you can view. You can make changes as needed. Everything goes into an audit log so that any change made is auditable and collectible. From a calculation standpoint, I'll just show you one because I don't want to spend a lot of time on this, but I'll show you a CECL calculation, for example. Let's say you want to use the vintage calculation, which is one that the Fed showed really early on in the process. So you might have charge-offs in a pool. Now, this is obviously a lot of charge-offs, but we're doing that in order to show, illustrate the process. If this was your bank's asset pool, I'm sure you guys wouldn't be in business right now. But anyway, so imagine these are all charge-offs, and then we convert those charge-off rates based on dividing out against the recorded investment. And you can see up here on the upper left, we've got a lot of different scenarios that we've run because, you have to figure out how to do this, and the only way to figure it out is to pull your data in and start working with it. The other thing you'll notice over on the left here is we divided this pool into 3 different tenors, or groups of loans based on term. Because obviously, if you have a vintage, which means you're looking at all the loans that were booked in a certain period, you really need to break it out into length of time, because you don't want to calculate the life of loan loss longer than you need to or shorter than you need to. We do offer economic indicators. You can see we can put in different look-back periods, which really represents life of loan, how many quarters you want to project. You put in we pull the charge-offs in directly from the core data, create loss rates. You can choose different economic indicators that we do supply, publicly available economic indicators, and then do projections based on our regression. You can use those or not if they're relevant to your portfolio. I don't know if national unemployment rate or the LIBOR index is that valuable for a community bank. More likely local information or specific to your footprint and assets. But that's up to you. We can facilitate whatever. You can provide your own. You can use Q factors instead. And basically our goal is to create something that looks like this. Up in the beige, you can see the loss information, and in the green you can see the projected information. That's just a couple things I wanted to show you. Let me show you a couple reports. Probably makes sense. So let's go back. Reporting is important because of all this subjectivity. You have to be able to demonstrate to the regulators and auditors why what you say is actually a reasonable, supportable argument. So let's just do it from here. Let's just show you a couple CECL reports. And then we'll wrap up. Obviously, we have all the traditional ALLL reports. So, you can take a look at things like an ALL closure report, which would be something that you would normally get at the end of an ALL, an automated ALL, which shows the models, shows you what calculation method you used, recorded investment and the individual impaired credits and the totals. I mean, that kind of report is pretty routine. But we also have some more advanced reports. So for example, one of the things that people want to look at is how can you justify changes, and what is it that happened in the, let's say, in your pool calculation that justifies needing to change your allocation. So let's say I were to pick a pool and run this attribution report. What this does is it takes a look at your current, your previous ALLL for the pool and your current ALLL for the pool. And in this example, in the last period, it's gone up. Now, the question is, how can you quickly show the board, regulators, why your allocation went up from the previous period? Each of these little categories are categories of activity in the portfolio that can impact the ALLL. So if your originations are up, obviously that's going to factor in. If you have payoffs, if your risk characteristics have changed in the profile, forecasts, charge-offs are up, all these things can impact the portfolio and why a particular pool might change. So I thought that was a kind of a neat report to just show that. In addition, we have reports that even look at things like the correlations of macroeconomic factors to So you might have said, so how am I going to do that? Well, obviously, if you have your loss history and you load your loss history into our program, we can compare your loss history to certain economic indicators during those periods and tell you whether the correlation is particularly effective or not. So in this one, LIBOR was effective, much more effective than other trends. housing starts, other things that, you know, the housing price index showed no correlation at all. These are some of the things that you might be able to use to help justify some of the things that you're calculating. All right, we're going to take we have 5 minutes left, so we're going to see if anybody has any questions other than asking why they couldn't see the slides, which is a really good question, by the way. I appreciate that. Other than that, I'm going to see, don't see anything else currently, any questions, but as you think about really what we can do for you, these solutions, if you think about some of the challenges that I've shared with you today, and you do end up having questions, then I ask you to contact me or go through CSI to contact me, and we'll try to answer your questions and get you started. You know, it is an important thing to deal with today. The regulators are going to start asking you what your plan is, what you're going to do, and I think that it's pretty clear that being able to offer a solution that directly connects your data with a best-of-breed solution like what we have today is going to be helpful. But this is a journey, not a sprint. So let us know what you're thinking. Please reach out and contact us. We will have more webinars coming up. There is another webinar available. I think you can register on your portal, on your Meridian portal. It's the day after tomorrow, and it's specifically about the boot camp. We're going to demonstrate the boot camp portal. We're going to talk about the value of that. So if you're interested and you have the time, day after tomorrow, please register and drop in on that as well. So that's all we had for you today. Thanks very much for your attention. I appreciate it very much. And hopefully we're looking forward to working with you on being your, helping you partner to get this CECL challenge taken care of. Thanks.